You sent your friend $12 for pizza. That's it. That's the whole transaction. $12, 2 taps, done. Except it wasn't done. Not really. Last year alone, over $1 trillion moved through apps exactly like this, and almost nobody knows what actually happens to it in between. In the 1.3 seconds it took for that money to move, at least 4 different companies touched it. One took a cut, another logged the data, and a third quietly added it to a profile that knows more about your spending habits than your own accountant does. And you paid for none of it. Or so you think. Here's the thing about free apps. They are never actually free. That's not cynicism, that's just accounting. Every engineer who built Venmo, Cash App, PayPal, or Zelle needs a salary. Every server that holds your transaction history costs money. Every fraud detection algorithm, every customer support rep, every sleek UI update, all of it costs real money. So when a company tells you their app is free, what they're really telling you is that you are not the customer. You are the product. And the strange part is, the better the app feels to use, the more profitable you probably are to it. But this story is more interesting than that, because the way payment apps actually make money is layered, counterintuitive, and in some cases genuinely brilliant. And once you understand the system, you'll never look at a payment notification the same way again. Let's go back to the beginning. It's 2009. The iPhone is 2 years old. Splitting a dinner bill still means someone awkwardly hands you cash, or worse, writes an IOU on a napkin. The friction of sending money between people is absurd. Banks charge fees for wire transfers. Checks take 3 days to clear. The entire system feels like it was designed in 1987. Because mostly it was. Then apps start showing up that promise to make this frictionless. Send money instantly, for free. No fees. The pitch worked. Of course it worked. Free is the most powerful word in marketing. Venmo launched in 2009, PayPal acquired it in 2013 for $800 million. Cash App launched in 2013. By 2021, it was generating $12.3 billion in revenue in a single year. Zelle processed $806 billion in transactions in 2023 alone. Billion with a B. So the apps are free, the transactions are free, and the numbers are staggering. Where is all that money coming from? Let's start with the most obvious mechanism, the one hiding in plain sight: interchange fees. Every time you use a debit or credit card or a payment app that connects to one, the merchant on the other end pays a fee. It's called an interchange fee, and it typically runs between 1.5 and 3.5% of the transaction. That fee gets split between the bank that issued your card, the card network like Visa or MasterCard, and the payment processor. Payment apps have inserted themselves into this chain. When you use a Cash App card, a PayPal card, or Apple Pay tied to a specific card, the app either earns a slice of that interchange fee or has negotiated a revenue share arrangement somewhere in the stack. You don't see it. The merchant pays it. You walk away feeling like you got something for free. You did. The merchant didn't. And if that merchant is a small business running on thin margins, that invisible fee isn't small to them. It's lunch money, rent money, survival money. But that's still the obvious money, the visible money, the money they don't mind you knowing about. Here's where it gets more interesting. The next layer is where things get clever. When you send money through Venmo or PayPal, the default option is to receive it into your app balance, not your bank account, your app balance. That distinction is intentional, because the moment money sits there, it's not really yours in the same way money in your bank account is yours. It's stored value, and PayPal, the parent company, holds billions of dollars in aggregate user balances at any given moment. In 2022, PayPal was sitting on roughly $34 billion in customer funds. Now, here's the quiet part. They invest it. Not wildly, mostly in low-risk instruments, treasury bills, money market funds, short-term bonds, but at 4 or 5% annual interest rates, $34 billion generates roughly $1.5 to $1.7 billion a year in interest that your balance earned and that they kept. This is called float. It's one of the oldest tricks in financial services. Banks have done it for centuries. Payment apps just made it invisible by wrapping it in a clean interface and a blue checkmark. Your $12 for pizza quietly worked a full-time job for a corporation before it ever made it to your bank account. Now we get to the part where the business model quietly flips: instant transfer fees. You know how when you want to transfer your balance to your bank account, there's a choice? Standard transfer takes 1 to 3 business days and is free. Instant transfer takes minutes and costs a percentage fee. Think about what's actually happening here. The company is holding your money. You want it back quickly. They charge you for the speed, not for moving the money, for stopping it from sitting still. They've created a toll booth on your own funds, and because the alternative, waiting, feels inconvenient, millions of people pay it without thinking twice. The goal isn't to charge you. The goal is to design a system where you don't realize when you're being charged. And here's the quiet irony. The technology to move that money faster already exists. The delay isn't really technical, it's financial. The float is more valuable if you wait, so the wait is incentivized, and then you get charged to skip it. That is a remarkably elegant business model, if you're the one running it. There's another revenue stream that doesn't get talked about nearly enough, and it's the one that should make you the most curious: data. Every transaction you make through a payment app is a data point, but it's not just a number. It's a timestamp, a location, a merchant category, a frequency pattern, a behavioral signal. Over time, your transaction history becomes one of the most accurate portraits of your life that exists anywhere. You go to the same coffee shop 3 times a week. You paid a therapist on Tuesday. You split a hotel room in March. You bought baby formula for the first time in November. You stopped paying for a gym membership in January and started paying for a meal kit service in February. None of this feels sensitive when you're doing it. It feels like $12 for pizza. But aggregated across millions of users, this data is extraordinarily valuable. Long enough timeline and your payment history can predict your life events before your friends know about them. Now let's zoom out for a second. For most of human history, the infrastructure for moving money was owned by governments and regulated banks. That infrastructure was slow, expensive, and often terrible at serving people without much money. Payment apps genuinely solved a real problem. They made financial tools accessible to people who couldn't easily get bank accounts. They reduced friction in ways that helped individuals and businesses. That part is real. The social value is real. But here is the uncomfortable math. The business model of payment apps disproportionately extracts money from the least financially sophisticated users. Instant transfer fees hit hardest when you need money quickly because you can't afford to wait. Float earns the most when users don't know to transfer their balance. Financial products are shown most aggressively to people whose behavior suggests they're the most likely to use them. The app is free. The people who can't least afford the hidden costs are the ones paying the most of them. That's not an accident. That's the model. And now these companies are not just apps, they're becoming financial platforms. They offer savings accounts, cards, credit, loans, investing features. The payment app is the Trojan horse. Once they have your transaction history and your trust, the upsell is seamless. And here is where it gets genuinely interesting. What happens when a company knows more about your financial life than any bank ever did, has fewer regulatory obligations, and a business model that profits from keeping you slightly confused about where your money is and how fast you can get it back? That question is being asked right now in regulatory offices around the world. It doesn't have an answer yet. The next time you split a bill with someone, the app will confirm the transaction in under 2 seconds. It will feel like nothing, like a service so simple it barely deserves a second thought. That's what 12 years of product design, billions in venture capital, and some of the smartest engineers in the world were hired to make you feel. It is an extraordinarily successful illusion. The pizza was $12. The system around it was worth billions.